Our study. Welcome to our study of the financial markets. This week, I'm going to lecture on the financial markets. The chapters that are being covered this week are chapters 18 and 19, but I'm only going to focus on the financial markets in this video. So, the book talks about the demand and supply for financial capital in previous chapters. And in this chapter, we look at the demand and supply for financial capital from a different perspective. We're going to look at how the demand for financial capital occurs. So businesses are demanding financial capital, and in what forms do they seek to supply it, and why, from their perspective, would they supply it in those different forms, or demand it in those different forms, excuse me. And for the supply of financial capital, those willing to supply financial capital, what are the reasons they would like to supply financial capital in different forms? So, firms require financial capital to make new investments in project. They are the demanders of financial capital. On the other side of the coin are households. Households seek a place to earn a return on their savings. Their investment their savings is actually their disposable income minus consumption. So we know that disposable income is equal to consumption plus savings. So anything that is not consumed is going to be saved. And their savings becomes the financial capital that firms use to make investments in new projects. So households are going to be the suppliers of financial capital. So there are different types of financial capital that might be demanded by firms. Venture capital refers to financial investments in new companies that are relatively small in size but have potential to grow substantially. So venture capital firms will have funding that they provide to new small firms where they see potential growth. Early stage investors provide financial capital, and in exchange for doing this, they get part ownership of the firm. So what they're going to say is, here is this funding that you can use to hire people or build a building or build a factory or buy equipment or do some marketing, and in exchange we would like to be part owner in the firm, and therefore when the profits come to the firm they will receive some of those profits. So that's the purpose of venture capital. Venture capital is used early in the early stages of a firm as it's being established, and it does not have much credibility in the markets yet. Firms can also reinvest their profits. So the problem with this though is that if firms are earning profits, they can choose to reinvest some of these profits in equipment, structures, and research and development. But timing can be an issue. So oftentimes a firm might not have the profits on hand to go and build a factory or buy new equipment that they need. And this can make their profits, being the way that they invest in their future profitability or new projects, to be an issue because they might not have the profits available when they see an opportunity. And actually, let's take a look at this. This statement up here really belongs with venture capital. So, sorry, venture capital is when firms, their venture capital companies, come in and invest in small, relatively unknown companies that have the potential to grow substantially. And there are many failures associated with this type of lending, so it's extremely risky. Okay, and then we talked about reinvesting profits. So you can reinvest your profits. You'll see this in public companies. Public companies do this when you see their retained earnings. So their net income is their profit, and after they pay taxes, they have their net income on their revenues, minus expenses, minus taxes, minus operating costs, etc., equals net income. And then their net income can be used to be reinvested back into the firm. You'll see that as reinvested earnings for a public company. It can also be used to pay out dividends. We'll talk about that in a little bit too, from the supplier of financial capital perspective. So the next couple of ways of accessing financial capital or money to make investments, when we look at how a firm can invest in new, potentially profitable projects that they would like to be involved in, is they can borrow from a bank, and they can borrow from a bank in the form of a bank loan. So if they have a record of at least earning significant revenues, the firm can then make a credible promise to pay interest on a loan. And then therefore it's possible for them to borrow money from a bank. So we call these bank loans. They can also take out a bond. In a bond, they'll actually go and access um, the bond market and the lenders in that market. So a bond is a financial contract through a borrower like a corporation, a city, or a state. So corporations will issue bonds. Cities and municipalities, states will issue bonds, and the federal government issues treasury bonds. So the idea with a bond is that you will say, okay, I would like to borrow $1 million and I will repay it in 10 years. Over those 10 years, I will pay interest on the bond, and the interest will be in this amount, say 5%. So 5% on $1 million will be the interest that you pay every year. So you'll be paying $50,000 in interest per year to have an outstanding debt of $1 million. And at the end of the 5 years, you'll pay back that bond plus interest. So the $1 million plus the $50,000 in the last year, if you're the company, because hopefully at the end of the time horizon that you've borrowed for, you now have the profits from your project. So you borrowed 1 million, you hired a bunch of people, and you had this really great idea to bring this sort of service-oriented product to market. Maybe it's some sort of new technology, and you developed it. And by the end of the 5th year, you now have the profits to repay the loan, to repay the bond. So corporate bonds are bonds that are issued by firms that wish to borrow. So and we talked a little bit about bank borrowing. So corporations might also take a loan out directly from the bank, and these are called bank loans. Now, the last sort of way that a demander of financial capital can access the market for financial capital, basically connecting up with the households who have the savings, is to issue stock. So stock is a claim on partial ownership of a firm. Shares of a stock are the idea that stock, so the ownership of the firm, is divided into individual shares, which households and companies and different types of insurance companies buy stock, etc. But different players in the market can buy this stock. And when a firm has what's called an initial public offering, or an IPO, they'll issue stock and sell it to the outside. And when they do that, they raise funding, and that funding can be used to buy factories, buy machinery, hire people, and work towards their goal of increasing profits for their firm. So from the firm's perspective, what is the optimal form of financial capital? When a firm is young and not established, it doesn't really have a lot of options. So venture capital is the main way that they're going to access the financial capital markets to raise the funding they need to expand their business. Angel investing, or angel investors, are another term for venture capitalists. So they will support the firm. They get to know the firm really well. They might even have people from the venture capital firm who are on site at these firms on a regular basis. They know the business plan. And by doing that, it overcomes the problem of imperfect information, where we don't have enough information to know if the firm is actually going to be successful. So the venture capital firm will give whichever firm they would like to, because they see that they're going to earn a lot of money in the future. They'll give them the funding they need. They become a partial owner in the firm, and they'll only do this once they overcome the imperfect information problem, and they know the management of that firm. They know their business plan, and they're very, very sure that this firm is going to be successful and earn a profit. That's not to say that there aren't many failures, as we noted before, but at least they're trying to overcome this issue of imperfect information. And if a firm is a little more established, they might issue stock or they might issue bond. If a firm doesn't know whether their projects are actually going to be very profitable, If they have a really good reputation right now, but they are not yet a public company, they might choose to issue stock. When they do that, when they issue stock and they receive financial capital for it or money for it from households who've invested in them, they don't have to normally pay out dividends. So they do not pay out any returns for a few years, and that would generally be dividends. If they're not having to pay out dividends for a few years until they're more firmly established and they're actually earning profits that they think they're going to earn, then this might be the right way for them to go. If you are issuing a bond, you're going to have to pay interest right now. The other thing is if they're not confident that they actually might be very profitable in the future. For example, the company Zynga is a really good example, and you can look them up. You can Google them. They are a company that produced a lot of the games that were on Facebook. Now, producing games on Facebook was a novel idea at the time, and Zynga made a lot of money doing this. But then a lot of people have sort of competed with them, and now there are different companies that create games on Facebook. I think Mafia Wars was the first game that Zynga introduced that was very popular on Facebook. So Zynga decided they wanted to expand their operations, and at the time, they were the main company that was creating these games that were played on Facebook by millions of people. So what they did is they issued stock in an IPO to raise money to perhaps expand their operations and maybe do different things in their company, not just do Facebook games, but do games in other places or do more games on Facebook. And when they issued that stock, they received financial capital in exchange for ownership of their company by all of the households and individuals who purchased the stock. But they haven't actually turned out to be extremely profitable, and the value of the stock hasn't increased very much. It's stayed very, very low over the last 3 years. Now, this was a smart move by Zynga, because if Zynga had instead taken out a bond of the same amount of what they received in income in their IPO, then they would have to pay interest on that bond, and they might actually be meeting a deadline to make repayment of the bond. However, with the stock price, if they're IPOing at a price of 30 and they're receiving income at $30 per share, and then they're not actually having to pay that money back ever. They've just said, well, we might pay dividends in the future and you should expect the price to go up, but the price falls. Then Zynga is really not on the hook for that. So perhaps when firms aren't making profits, or they are making profits but they're not confident that they'll make profits in the future, an example would be the company Zynga, it might be a good idea for them to issue stock instead of bonds. Another thing is that if you see a company that is issuing stock and they're already an established company, they might be a young company, but they already have stock that you can buy in the secondary market. So they've already IPO'd and raised their initial capital. If they're going back into the stock market to raise more money, it can be assumed that perhaps they were turned down for a bank loan or bond offering, or again, that they are not really confident that they'll be able to pay back that bond in the future. So it's something to be sort of leery about as an investor. But as a firm, it's a smart move if you are not quite sure that you're going to make it. You might want to issue stock instead of bonds. So the mirror image to this discussion is really, how do households invest their income? So they're not going to invest in the same way that a business does. They don't buy machinery and capital and put it to work in firms. What they do is they have their disposable income, and what they do not consume, they save. And when they save, that savings goes into things like their checking account or savings account or bonds or stocks or mutual funds that hold bonds and stocks. And that is a way for the businesses to access their financial capital, their savings. So, they're not, a business isn't walking up to my door and asking me for some money to expand their operations. But what they're doing is, I'm saving, and then they're accessing that savings and making their investments in human capital and machinery and factories and all the things they need to be profitable in the future. So if you're an individual, you are going to perhaps have a checking or savings account. So a checking account is going to pay little to no interest, but it's the most liquid form of savings. You can write checks or use your debit card to access these funds immediately. A savings account, in this day and age, it's pretty easy to transfer your savings into your checking. And so the difference between the two is not totally different. There are different rules on checking and savings account as to minimum balances and maximum amounts of transfers per month. So I think that's where you'll see the majority of differences between the two vehicles. A savings account pays interest, albeit a very low amount of interest. And if you want to access the funds, you typically have to take a trip to the bank or use an ATM. ATM stands for automatic teller machine. In addition, you could save your money in the form of a CD. So a CD is a mechanism for a saver to deposit funds at a bank and promise to leave them there for a period of time. Generally, there's 6-month, 1-year, 2-year CDs. Current CD rates are very, very low, and I would say they are an unattractive vehicle for savings because of this. The difference between your savings account interest and your CD interest is very low. Unless you have a very, very large amount of money to put into a CD, you're really not going to see much in the way of interest. So bonds we can invest in, right? So firms are issuing bonds and individuals can buy bonds. You could buy junk bonds. Um, they're called junk corporate bonds, and they are going to be the bonds of firms that are typically very risky. You could buy highly rated corporate bonds. Corporate bonds would be firms that are highly respected and have a track record of excellent profits, and therefore you would believe that they definitely will be able to pay you back the interest and the principal, which is the notional amount of that bond that was issued at the end of the life of the bond. They're then going to pay lower rates of interest versus the junk bonds that pay higher rates of interest. You could buy the bonds of foreign countries such as the UK, German bunds, so they're called gilts in the UK and bunds in Germany. Or you could buy emerging market bonds. You could buy bonds from Venezuela or Brazil or Mexico. Those are going to have a higher rate of interest, so you're going to earn more interest on those emerging market bonds than perhaps the British bond or the German bond, which is less risky. You could buy bonds from California, municipal bonds. Bonds are specifically tied to different streams of income. So a certain tax is levied and certain work needs to be done, and therefore there's a bond associated with that taxation and that work, and you expect in the future to receive interest and principal. You could buy treasury bonds from the US government. And all of these different bonds have different yields. So it's really up to how much risk do you want to take for the amount of return. And we'll talk about risk and return in a little bit. So the bond yield is the rate of return that a bond is expected to pay at the time of purchase. Now, bonds also, like stocks, trade in the secondary market. So you can buy a bond that actually was issued a few years ago. And depending on what interest rates are doing, if they've gone up or they've gone down, the price of that bond might have changed. Let's say, for example, that Apple has issued a $1,000 bond payable in 5 years at 5% interest. Now, if interest rates have gone up substantially and bonds similar to Apple, maybe they have issued new bonds since then are now at 6%, the price of that bond will have fallen. So you'll be buying the bond at a lower price than $1,000. So it'll be maybe $900. And you'll pay $900 for that bond. Now, over the next few years until that bond matures, the bond will go up in price. It'll accrue to its notional value. And you'll be able to sell that bond for $1,000, so you'll capture the $100 price appreciation on that bond, and you'll also be earning the 5% interest. That $100 price appreciation is important because otherwise you could purchase a bond and earn 6%. So that's sort of how the bond market smooths things out with the bond yield. So the rate of return is based not only on the interest that you're earning, but on any price appreciation or depreciation that should happen over the life of the bond. Most individuals, and I would say this would be the majority of individuals unless you're a very astute financial investor, own mutual funds. So mutual funds are pooled vehicles where individuals can buy into a fund that owns a variety of stock or bonds or stocks and bonds. They are from different companies, different countries, and this allows an investor an easy way to diversify. So I might own a mutual fund that primarily invests in the Standard & Poor's 500 index. You can look that one up, S&P 500. And that's going to be the top 500 largest companies in the US by market capitalization. And if I buy into that, I now have access to the returns of all 500 companies, a very small bit, right? Say I spend $10,000. Obviously, I'm not going to access full shares of each company's stock, but I'm going to have access to the price appreciation and dividends of those stocks for however long I hold that mutual fund. And the way it works is that, well, I will put money in, you will put money in, many people will put money into this mutual fund, and that allows an asset management firm to go out and buy all of those stocks that it needs to buy to accurately represent the S&P 500, those top 500 largest companies, depending on how many individuals have purchased into their mutual fund. So this is a good way to easily diversify. I don't know what the value of the S&P 500 would be. This is something you could Google also. If you wanted to buy one stock each from all of the firms in the S&P 500, but I assume you'd have to have a good bit of funds to do that. You could also buy housing and tangible assets if you're a household with savings. You could buy homes, art, collectibles, commodities such as gold and silver, for example. And I know that investment in housing and other tangible assets is actually extremely popular in our area in Humboldt County. People do tend to buy homes and land, maybe not so much art and collectibles, but even commodities perhaps. Stock and bond and mutual fund investing is a less popular route here. We have a more traditional sort of economy. So, and another really interesting statistic is that most people's wealth, so they have most of their savings actually in their primary residence or their home. So this is an interesting point about where our savings goes as a society. So risk versus return. The more risk you take, the more potential return there is. So there's going to be more potential return on that junk bond than there is going to be on a British gilt. Because we trust that the British government is going to pay us back. They're going to pay us interest over the length of the bond, and they're going to pay us back the principal or notional amount of the bond. But a junk bond could be some company that really is little more than a startup that we know little to nothing about, and they really have no incentive to pay us back except for if they decide to continue their business in the future. So if for some reason they go belly up, they're not going to pay us, and they have no reason to pay us. So there's also going to be more short-term volatility in an asset generally if there are higher potential returns. So junk bonds, if you buy a junk bond, you'll see the price move around quite a bit. Whereas if you buy a bond that's issued by a large developed country, such as the United States, you won't see generally as much price volatility. It also depends on the length and maturity for the bond. So stocks are risky, and in the short term, you'll see a lot of volatility in their prices, but they do offer long-term high returns. So if you're just starting out working, or if you're pretty young and you know you're not going to be going into retirement and needing to access too much of your savings for too long, it's reasonable to invest in more risky assets such as stocks and junk bonds or long maturity bonds. And it might make sense because you're not going to need that funding for quite a while. So a lot of people will save for their retirement in their 401ks or in their IRA plans with stocks as a young person. As you get nearer to retirement, you already own a house, you're also going to prefer less risk in your portfolio as you're going to need that income soon. So, if you own a lot of stocks and they tend to go up 10 to 15% in value per year, you have $1 million and it goes down 15%, that's not a big deal when you're young. You'll also probably have less money. You might only have $100,000 in your savings as someone in their, working years. But as you edge towards retirement and you have significantly more income saved up, if 15% of $1 million is $150,000 and your portfolio falls by $150,000, that's not quite a good thing. You're really going to want to sort of lock in the returns that you've earned over the lifetime of your savings and be able to live comfortably. So remember that some bonds can be relatively risky too. And those would be more of the junk bonds, the bonds that are they have low ratings, so bonds are rated AAA through I think it is D-rated bonds. And the lower the rating, the higher the risk, and the less certain we are that there will be return. But there could be a lot of return on those bonds too, and they carry higher interest rates. Tangible assets can also be relatively risky investments. So people are always going to need homes, and they're always going to need their primary residence. But we saw this in the last recession, that home prices depreciated rather substantially and quickly, and this caused issues for many people and many companies who had made mortgages, so banks who had made mortgages on these homes. So tangible assets can be very risky. Gold and silver tend to fluctuate substantially over time, and home prices or art and collectibles, land, those can also be pretty risky investments, but then they do earn a higher return. So something to think about is the risk-return spectrum when you're looking at what you might want to put your savings into. I know that everybody here is taking this class because they would like to go they're pursuing higher education, possibly for a better career. And once you're in that better career, if not already, you're saving a little bit and you're saving for your retirement. So these topics are really important topics, and I hope you enjoyed this discussion. For the discussion forum post, do not feel restricted by our discussion here today. You can also discuss chapters 18 if you would like to in the discussion forum post, subject to the instructions for the rubric. So please let me know if you have any questions about this material. I'm happy to set up discussion forums, and I hope everyone has a wonderful week. Take care.